Guys, welcome back to the channel. Welcome back to the video. My name is Steve. If this is your first time stopping by the channel, hit that subscribe button. Trust me, you won't regret it. And if you're a returning subscriber, as always, welcome back. Guys, I want to talk a little bit today about what happened. I mean, as you all well know, since the time I'm recording this video, you all done heard about it. That CPI numbers have came out, and it shows that inflation is starting to cool down and starting to go down. We were at 7.1%, I think. I know we were in 7.1. And like now we presently stand at 6.5%, which is a good thing. I mean, it's showing that, you know, the Fed rate hikes are working. Now, as far as the numbers go, it was right on time with the estimates of what the Fed thought was going to happen. So it's a good thing. But I want to say something. A lot of people are jumping up and down and saying, oh yeah, this is good, this is good, this is good. It is good, but you got to also look at it like this is exactly what the Fed predicted. So as far as them doing rate hikes in the future and all that stuff, this does not deter that. This just validates what they were saying of, okay, yeah, it should be at 6.5% or whatever at this time. And now it's come true. It doesn't change the hawkishness or the dovish of whatever you think is going to happen in the future. Things are sitting correctly where they are. I just wanted to say that. Now, with things being the way they are and sitting the way they are, as expected, this is what I plan on doing. First thing is this, you know, I'm putting a lot of my money, you know, I'm recalibrating some of my portfolio. A lot of my winners that I've had in the past, I'm starting to shed some of my shares from selling some of my shares and then buying into other shares of other stocks and funds to protect myself in 2023. The main thing I'm doing is, you know, investing my money in broad-based ETFs, stocks like VOO and VTI. You know, I'd rather spread my money across the broader part of the market in multiple companies rather than have it in just one security, to where if something goes wrong, my portfolio could take a hit, a bigger hit than it should. With this, you know, VTI and VOO, I'm just investing in the market, period. So when the market goes up, it helps the portfolio and it helps my money and it helps me sleep at night. I get great returns with minimal market stress. And that's basically, you know, my thing. And if you're a new investor out there, this is a great way to introduce yourself to the market. In fact, anybody that starts in the stock market should always put their money in the ETF first until they figure out the ebbs and flow of what the market does and getting the understanding for, you know, managing a portfolio. ETFs are the perfect thing. You know, and I've said that before in my other videos. It's just something to think about. Now, second thing is this. If you do deal with stocks, you want to make sure that your portfolio is properly weighted. You don't want to have, when I say properly weighted, what I mean is you don't want to have a high percentage of stocks that are in the same sector or a certain amount of weight in one sector where it outweighs another sector that could go up, where you know how it is in the market. Certain sectors take off sometimes, certain sectors, you know, fall. It's a part of life. You know, it's not a bad thing, and it's a yearly thing. You know, stocks move up and down up to 50% per individual stock every year, you know, in a good direction or a negative direction, but it always is what it always is. But the thing is this, you don't want to have your portfolio weighted in such a way to where a certain amount of stocks or one stock will outweigh, because of its popularity or how you see the stock in the future, will outweigh a lot of other stocks, to where it will shift the balance of your portfolio monetarily wise in a positive or negative direction, because anything is subject to change in the market. It can't be timed, it can't be predicted. So me personally, in one of my portfolios where I have mainly a lot of my stocks, between 7 and 3% of the portfolio, one stock, you know, quantity wise, share wise, will be to where if something does go awry, you know, 7 to 3% of the portfolio is affected price wise. So that's one of the things you want to do. You want to make sure your portfolio is weighted properly, you know, where you disperse the money out. And say you might have, you know, a lot of people, I say recalibrate your portfolio. This is what I'm talking about. You might have 12% of a tech stock, right? Tech might be affected, you know, during the year or whatever. Like, 'cause I mean, everybody done took a hit, and you might want to bring that down by 5% and disperse that in the other, you know, stocks in your portfolio, the way you could bring their percentage up and then even out the percentage, thus, you know, helping out your losses in case you do occur anything. Nothing messes you up like that, you know, because the percentage is so small. And remember, when things fall, other things are rising. So it's one of those things you want to pay attention to. Speaking of pay attention, continue the dollar cost average, which basically means a certain amount of money every month or every 2 weeks you can attribute or put it into your portfolio. And while you're putting it in your portfolio, you can either buy into stocks, you know, your favorite stocks, your winners, or you can have it just in your account and get ready for a lot of these stocks to fall, or values that you see on your watch list where you can go and make moves. But a lot of times when you're doing dollar cost averaging, it's usually just putting the money into your stocks, you know, your favorite stocks, and just buying position, you know, buying more shares as you put the money in. But I mean, it's entirely up to you. The other thing is, if you're going to deal with stocks, you want to invest right now, because a lot of stocks are off their 52-week highs, and we're in a recession, and inflation is, you know, still going down. So the market is extremely affected. You want to put your money in winners. And when I say winners, I'm talking about you want to invest in blue chip stocks, mainly boring dividend stocks, like they pay a dividend and they're boring, meaning they don't fluctuate with the market and all this other stuff. They're just steady performers. A lot of dividend aristocrats are considered boring stocks. You know, Tesla is more like a growth stock, where, you know, Tesla can sporadically go up, it can sporadically go down. That's not a boring company. You get a lot of palpitations in your chest. You don't want that, you know. And I'm not saying anything about Tesla being a bad stock, because I mean, I own stock too. But you want to invest in stocks that are winners. And I'll give you an example of some stocks. You know, Merck, Procter & Gamble, these are like boring stocks, but they pay a good dividend and they're steady performance. Cisco, Altria Group. What else we got? Unilever is good. Coca-Cola. Verizon, to name a few. You know, it's a lot of stocks out there. Now, I'm not saying go out and invest in these stocks right now, because a lot of them may be overvalued, you know. But I mean, just do your due diligence. And it's a lot of stocks out there that are going to pay good dividends and they're steady falling. Because you got to remember something, guys. If you've been paying attention, a lot of major corporations are being affected by these rate hikes. You got layoffs. They're laying a lot of people off. You know, you got a lot of issues with them, you know, with operational issues. And when I say that, it's cost issues. They got to keep their costs down too. Just like we have to budget money as consumers, they have to budget money too to keep themselves above water. Because remember, inflation and these rate hikes and stuff, it makes it more expensive for them to even borrow money. So they have to manage everything too. They're going through it just like we are, guys, these companies. And that's why their stock prices are going to come down. They got to cut down the they got to cut down their operational costs. They got to cut down, you know, a lot of the manpower and stuff, because with money being more expensive for them to borrow on credit and things like that, they don't want to kick out a lot of money. And then, you know, the performance of these companies are slowing down. Remember, the Fed is trying to stop spending. And when you stop spending, what happens? Businesses don't make money. They don't make money, they're not going to pay all these people. So they're not going to take hits. They're going to start letting people go. That's, you had the layoffs, and we had operational issues because they're shutting down certain parts. Like, different companies are shutting down plants all over, you know, where they're stopping operation on certain parts of something that they're producing that doesn't make a lot of money. It's a lot of things that are going around behind the scenes that we don't know about, but it's still affected from the inflation hikes, like it affects us, you know, price of food and stuff. Let's see what else we got. Earning week is coming up. Well, it starts tomorrow, basically. I mean, a lot of the big names, especially the banks, financials, you'll start to see tomorrow. Where we got JP Morgan Chase, Citigroup, BlackRock. I think United Health is tomorrow too. JP Morgan Chase. I don't know if I just named that. But, you know, this is the beginning. And like I said before January through April, we'll start to see the effect of these rate hikes. But that's just the tip of the iceberg. This thing is going to go, you know, all the way into 2024. So a lot of companies now, and this is just the tip of it, meaning we're in January, we're going to see, remember all them rate hikes we had into 2022, you know, last 4 or 5 months. Now we're going to start seeing the effect it has on these businesses. Like I said, we got a lot of layoffs, so we'll see what's going to happen. They're going to try to keep these numbers up. But like I said, a lot of these companies are going to fall into value territory. And that all comes down to, you know, consistently getting your cash reserves up, dollar cost averaging some of these winners. Because a lot of you guys out there, you got a lot of stocks that are, you know, diehards, dividend aristocrats, and you'd love to have more. Some of the stocks that you guys are holding and dollar cost averaging into, which you should not stop doing, are going to come down at a value, and it's going to blow your portfolio up because you're going to be buying more of what you like. And that's basically it, you know, for now. But I mean, the CPI numbers came in, they were favorable, but everything is going, it's going par course. Everything is in line. I don't put too much in it, like getting happy, like, hey, the market is green and all of this. I mean, it's a good thing, but I mean, we still, you know, the seas are choppy, but the heavy rain hasn't started to fall yet. And we won't see that probably till 8-9 months from now. But just be aware, have a plan, have a strategy, have it set up to where you guys know what you're doing. And when things strike, when it gets to the strike price you want, you'll have the cash reserves. You'll have the money. You've been dollar cost averaging, doing all the positive things you're supposed to do as an investor, putting your money in high quality dividends and broad-based ETFs. And when this thing turns around, you're going to be all right. But as always, I'm Stock Market Steve. Listen, guys, leave me a comment. Tell me what you think about CPI numbers and what your plan is going forward in 2023. And always like, comment, share, and subscribe. I'll see you guys in the next video. Thank you.